Western Union trades at $9.50. Dividend yield roughly 10.6%, multi-year lows.
And they beat the last quarter. Revenue above consensus, EPS above consensus, and the stock still acts like it's in hospice.
That's the paradox. A legacy money transfer business in structural decline, but a digital arm growing 32%, and a yield that screams either opportunity or warning.
Tomorrow morning we get the first print of 2026. Either the digital pivot is working fast enough, or this is a value trap with a coupon attached.
Western Union traces its roots to 1851, originally a telegraph operator. Same DNA behind stock tickers and standardized time zones.
And now, 175 years later, it's a remittance network that moves cash across borders for people the banking system ignores.
Headquartered in Denver, Colorado, 500,000 plus agent locations operating in more than 200 countries and territories. 11,000 employees.
Two segments. Consumer money transfer, the legacy engine, did $3.507 billion in fiscal 2025. That's 86.6% of revenue, and it was down 8% year over year.
The other segment is consumer services, branded WU+. $543.3 million in revenue, up 32%.
So you have a shrinking 86% and a growing 14%. The math is the entire story.
Market cap sits around $2.95 billion, beta 0.54, so it behaves defensively relative to the tape. The mode is regulatory, brand, and distribution in underbanked corridors where a competitor cannot just show up.
Devin McGranahan took over as president and CEO in December 2021, Harvard MBA, dual undergrad from Penn and Wharton.
External hire, 20-plus years at McKinsey, then Fiserv. He's the first chief executive of this company who didn't come up through the legacy agent network.
Which matters because the legacy agent network is exactly what's eroding. You want an outsider if the strategy is to pivot the balance sheet toward digital and crypto rails.
His fingerprints are clear. W plus digital acceleration, the USDPT stablecoin initiative, and the Intermex acquisition to deepen the U.S. to Latin America corridor. That is the playbook. Most recent print was the fourth quarter of 2025. Adjusted EPS of 45 cents against a 43-cent estimate. Revenue $1.008 billion versus a consensus of $990 million.
A 2-cent beat on the bottom line and a clean top-line beat, and the stock still drifted lower.
Full year 2025, revenue $4.051 billion, down 4%. Adjusted EPS of $1.75.
And guidance for 2026, revenue $4.253 to $4.374 billion, adjusted EPS $1.50 to $1.60.
Midpoint of the forward EPS projection is $1.55. On a stock at $9.50, that's a forward multiple of roughly 6 times.
Trailing price to earnings is 6.15 times, EV to EBITDA 5.20 times, price to sales 0.73 times, dividend yield 10.59%.
Margins are healthy for a declining top line. Gross 37%, operating 18.7%, net 12.3%, return on equity 52.2%.
Balance sheet: $1.2 billion in cash, $2.9 billion in total debt, $1.7 net, free cash flow of $505.2 million, up 36.9% year over year, payout ratio around 62%.
So the dividend is covered. That's the point. This is not a broken balance sheet. It's a compressing revenue base with a very real cash engine. Roughly 30 analysts cover the name. About 4 buys, 18 holds, and 8 sells. Mean price target around $9.75.
Which means the stock at $9.50 is basically at the target. The street is not modeling upside, they are modeling stasis.
Recent actions: JP Morgan at neutral, Barclays equal weight, Goldman Sachs buy, Wells Fargo underweight. A genuinely split book.
And that split is the whole debate. Fairly valued at these levels, or a value trap that still has another leg down when reality catches up with the multiple.
4 pillars on the long side. First, W plus growing 32% in fiscal 2025. If the first quarter print holds above 30%, the digital thesis gets real credibility.
Second pillar is USDPT. The stablecoin initiative is set to launch in the first half of 2026. If you can settle remittances on crypto rails, you cut costs and potentially expand margins in a segment that was assumed to be in permanent decline.
Third, the Intermex acquisition adds depth in the U.S. to Latin America corridor and brings approximately $300 million in revenue synergies. That's not a rounding error on a $4 billion revenue base.
And fourth, valuation, 6.2 times earnings, 5.2 times EV to EBITDA, a 10.6% yield. You do not need a growth story to re-rate this. You just need the decline to stabilize.
Stability alone is a catalyst when expectations are this low.
Counter side. First, consumer money transfer down 8%. That's not cyclical, that's structural. The cash-to-cash remittance model is losing share every year, and W Plus may simply not scale fast enough to offset it.
Second, the Iraq corridor. It is a top 5 corridor for the company. Any regulatory action there is material to the consolidated top line.
Third, the proposed 1% U.S. remittance excise tax. That is a direct compression of transaction economics in their largest send market. There is no mitigation strategy that makes that a good thing.
Fourth, competition. Remitly grew 29% last year. Wise is taking digital-first wallet share from younger senders. The people leaving Western Union's agent counters are not coming back.
And if WU Plus has to compete on price with Remitly and Wise, margin on the digital segment compresses right as it becomes a bigger share of the mix. That's the bear's trapdoor.
Remittance and payments comps, not the fleet card universe. Western Union's rivals span legacy money transfer and digital-first challengers.
Remitly, ticker RELY, $1.6 billion in revenue, growing 29%, price to sales around 2.8 times. The fastest grower in the space.
Euronet Worldwide EFT, $3.65 billion in revenue, up 5%, price to sales 0.95 times. More of a legacy money transfer and ATM operator.
MoneyGram is private equity owned, roughly $1.5 billion in revenue, smaller, direct comp, but no public valuation anchor.
Payoneer, $980 million in revenue, up 18%, price to sales around 2.1 times. More B2B payments than pure remittance, but same rails discussion.
And here's the uncomfortable number. Western Union trades at 0.73 times sales. Remitly trades at 2.8. Remitly is growing almost 4 times faster. The discount is not irrational, it's a growth gap.
Put-to-call ratio is not cleanly available for this name heading into the print, so we'll flag that as not applicable.
What we can see in the flow is elevated put activity on the 9 strikes and call activity building at 10 and 11. Two-sided positioning with a slight put-side bias.
Insider side. The chief financial officer sold roughly $1.2 million worth in the fourth quarter of 2025. No open market insider purchases over the trailing 12 months.
So no conviction signal from inside the company going into a meaningful earnings catalyst. That's not a red flag, but it is not a green light either.
This is a genuine value trap debate, and both sides have real evidence.
The fundamentals are fine. Free cash flow is positive and growing. The dividend is covered at a 62% payout. Costs are coming out of the model. Nothing about this balance sheet says distress.
The question is entirely timing. Can WU Plus grow fast enough to offset consumer money transfer before the market loses patience and the multiple compresses further?
And with the stock sitting right at the mean analyst target, the street is priced in mediocrity. Not failure, not recovery, just muddling through.
One of those is wrong. Either the digital pivot takes hold and this re-rates higher, or the structural decline accelerates and the yield becomes a warning rather than a cushion. Tomorrow's print is the first real read on which side is winning. Full research archive and show notes live at chargedalpha.com. Until next time, stay charged.
Stay charged.
2 things to watch when the first quarter drops tomorrow morning. Number 1 is the WU Plus growth rate. Full year 2025 was 32%. Does the first quarter hold above 25%?
That is the single most important number in the release. Above 25 and the digital thesis is alive. Below 20 and the bear case gets oxygen.
Number 2 is Iraq corridor commentary. Any regulatory language from management on the call, any hedging, any mention of licensing friction is the top near-term risk signal.
Everything else in the release is secondary to those 2 data points.
That's our look at Western Union heading into the print. Show notes, the full research archive, and our tracking models live at chargedalpha.com. If this helped you think about the name, please share it with someone who owns it or is thinking about owning it. Until next time, stay charged.
Stay charged. This podcast is for informational and educational purposes only and is not financial advice, nor is it a recommendation to buy or sell any security. All investments carry risk, including loss of principal, and past performance is not indicative of future results. The hosts may hold positions in the securities discussed. Listeners should conduct their own research and consult a qualified financial advisor before making any investment decision. Charged Alpha is independent and not affiliated with any company mentioned in this episode.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.